This year's volatile market and economic turmoil have been a challenge for investors who are trying to gauge the Fed's next move. Joining me now from Manhattan's meatpacking district, SoFi Head of Investment Strategy, Liz Young. Liz, thanks for coming on the show.
Thanks for having me. Great to be here.
So obviously, the Federal Reserve has made it crystal clear that it is not going to stop hiking until something happens. And we're maybe seeing something happen in the tech sector, right? All those layoffs. But retail numbers pretty strong, jobs numbers pretty strong. Should investors be worried that they're just going to keep going?
Well, I don't think investors should worry that they're going to keep going, because if they stopped prematurely, that would cause more problems down the road and we wouldn't get inflation under wraps. So you're right that some stuff has started to happen in the tech sector, in the sense that we've obviously seen a huge market correction in tech stocks and communication stocks, or basically those two sectors that would comprise growthy areas of the market. And now hearing layoff announcements, yes, there are some cracks forming, but what I think the Fed is really focusing on is they need something to happen in the inflation data. They need to get more comfortable with where the inflation data is headed. And we've seen some move in the right direction, meaning downward, but still sitting at a pretty high level, just under 8%. So I don't think they are nearly satisfied with that yet. And I do not think that they are going to pause or stop anytime soon.
That's a very good point, that the cure, while tough, is not worse than the disease. Inflation
That's
would be
correct.
worse, so thanks for saying that. Okay, so what does all this mean for the stock market? I know it's a tough question, but do you think the bottom has been in? And whatever you think there, are there areas of the market where maybe you're being opportunistic, big, small, foreign, domestic?
Yeah, so first of all, I'm going to stop short of saying anything about when a bottom either maybe did occur or might occur in the future. I don't think that we've seen the last drawdown of this cycle. That's what I will say. I think that this recent rally over the last month and a half has been really powerful, and that is typical of bear market rallies. But if you look at just the trend in general, the market is still moving downward. So this recent rally has been fun, and I hope that people are enjoying it, and I hope that people have used it as an opportunity to maybe sell some of those winners or trim some of the gains if you were trying to do that before. But I do fear that there is likely another leg down before we really get on the other side of this. And some of the signals that I would be looking at to see that are, we do need to see the economic data really break. And now we're seeing some of the what we would call leading indicators point towards contraction. So things like manufacturing new orders, those are in contraction territory. Things like small business optimism, very, very low, near COVID lows at this point. And obviously we're seeing layoff announcements and some other announcements of company guidance being pressured into 2023. So there are indicators and there are things definitely softening, but we really need to see it get deeper before I can be comfortable saying, okay, the market has gotten the worst behind it.
Fair enough. I want to pivot to student loans because SoFi is in that business. Does the prospect of student loan forgiveness change your advice in terms of how much people should pay off, how quickly people should rush to pay off their loans?
It doesn't really change the advice. And one of the rules of thumb that we use is when you're looking at how much leverage you have as a consumer, so how much debt you have as a consumer, if you're paying an interest rate that is above what you could expect from, say, a regular stock market annual return, and over a long-term period, the S&P 500 tends to return about 7% annually. So if you're paying an interest rate that's considerably higher than that, you should look to reduce that rate if it's available to you. Now, the forgiveness program is something that likely takes away a portion of people's overall student debt load, but it does not erase the entire thing. So there's still a lot to be said for managing debt levels. And even if you look at the data that we've seen over the last few months, credit card debt in the United States has soared. And that's something that does concern me a little bit. I don't want consumers to get too over-levered, especially into a rising rate environment.
Yeah, whether it's a 7% student loan or a 17% MasterCard debt, you want to get out of that as quickly as possible. One more pivot here, and that would be to crypto. SoFi does give people the opportunity to trade crypto on your platform. First of all, do you recommend a small allocation to that space? And if you do, should we be worried about the safety?
Yeah, hot conversation right now. Look, I have long said crypto can be something that you can play in on the margin, but in very small amounts. This is not an asset class that you put your rent money or your mortgage money in. Obviously, we've seen why that is. We've seen crypto go through a boom and bust cycle, and now we're at a point where we've got some company failures on top of that and leverage issues within the system. So this is a very risky asset class. If you are somebody who's building your nest egg, I would stay away from it for now unless you can really stomach the risk in it and really look over a long-term period to ride out some of those bumps.
Yeah, there's no way to say. The price-to-earnings ratio looks good on Bitcoin right now. Tough to say how far that can fall. Liz Young, thank you so much.
Thank you.